If you own Bitcoin right now, this is the worst it has felt in over a year. Not just the price, the feeling. Because Bitcoin is down while the S&P 500 sits at a record high for the ninth month in a row. While AI stocks doubled in weeks. While gold ran more than 30% on the year. Every single asset on Earth is green. Every single one, except the one you're holding. The opportunity cost is staring at you on every chart. And the temptation right now is to capitulate. To sell the boring red thing and go chase everything green. This week, CNBC will give you 3 explanations for why crypto is crashing. Every single one of them will be wrong. Or at least critically incomplete. Once I show you what's actually happening underneath this chart, you will not be able to unsee it. The financial media cycle runs on one thing: attention. And fear sells better than analysis. This is not an opinion. It is a business model. When prices fall, the headlines will give you a narrative. Not because it's accurate, but because it moves clicks. And if you let your conviction be swayed by a journalist who does not own any assets, you will lose. So here is what the headlines are going to tell you this week. Bitcoin is crashing because of the macro environment and Fed policy. Bitcoin is crashing. The common explanations: regulation uncertainty, macro headwinds, or crypto being speculative garbage. But are these explanations actually telling the full story? Suspect number 1, the macro narrative. If the market was truly risk-off, everything would be falling together. But look at what's actually happening. The S&P 500 just closed at a record high. Gold is near record levels. AI stocks have doubled in weeks. Bonds remain steady. These are not the patterns of a market running scared. These are the patterns of a market rotating, moving money from one asset to another, not pulling it from everything at once. Since 2019, Bitcoin and traditional risk assets have moved nearly in lockstep. That correlation just completely broke down. Bitcoin is now the only major asset consistently falling. Even Bitcoin's dominance is falling. Altcoins are actually performing better than Bitcoin right now. A macro explanation requires everything to fall together. This time, only one thing is falling. If the cause were macro, we'd see a broader market collapse. We don't. Which means the cause is not macro. The cause is inside Bitcoin itself. And that changes everything about where to look next. Suspect 2, the regulation narrative. Here's what's actually happening in Washington right now. The Clarity Act just passed the Senate Banking Committee. The Treasury Secretary is publicly lobbying Congress to get it done. The SEC chair has backed the bill's progress. And the Federal Reserve's new chair just said on record that if you're under 40, Bitcoin is your new gold. Meanwhile, Congress is actively debating the ARMA Act, a bill to acquire 1 million Bitcoin for the U.S. Treasury. 5% of everything that will ever exist, funded in a budget-neutral way using unrealized gold gains that have been sitting frozen on government books at 1973 prices. Let me say that again slowly. While CNBC is running the regulatory fear narrative, the United States government is writing legislation to own 5% of all Bitcoin that will ever exist. This is not regulatory fear. This is regulatory clarity arriving in real time. The media is not wrong. It is late. Throughout history, precisely when the headlines are most terrifying, the smart money is doing the exact opposite of what the news suggests. When the news screams regulation is coming, BlackRock is filing for an ETF. This pattern has never reversed. Throughout history, the pattern has never reversed. Suspect 3, it's just crypto. This is where the argument gets genuinely interesting. Because there's something hidden in the on-chain data right now that the volatility narrative completely misses. There's a metric called the sell-side risk ratio. In plain English, it measures how much financial pressure investors are applying to move Bitcoin. High ratio means lots of buying and selling force. Low ratio means a ghost town. Nobody's applying pressure to the network at all. Right now, that ratio has collapsed to a level that has only appeared 3 other times in Bitcoin's modern history. The late stage of the 2018 bear market, the late stage of the 2020 accumulation, and the late stage of the 2023 bear market. Those are not random moments. Those are the moments that immediately preceded the largest price moves in Bitcoin's history. Peak apathy, the moment when almost nobody cares, is not the end. It is historically the setup. Volatility is the price of admission, the fee you pay for performance that has outperformed every other asset class over any 10-year window you care to measure. This is not crypto dying. This is exactly what the late stage of a bear market looks like. So if it's not macro, not regulation, not speculative collapse, what is actually driving this? Two things. And neither of them are in the CNBC segment. The first is institutional rotation. American institutional desks are right now selling Bitcoin to rotate into AI and semiconductors. This is visible directly in the data. The Coinbase Premium, which measures whether American institutional desks are net buyers or sellers, has gone negative. On Wednesday, a single dark pool block trade hit BlackRock's IBIT at $1.3 billion, the largest single trade in the fund's history. Their second worst outflow day ever followed 24 hours later. The fast money is not leaving the market. It is chasing the hottest horse because they desperately need to outrun inflation. Right now, that horse is AI. This is not Bitcoin being broken. It is capital behaving exactly the way capital behaves in an inflationary environment with shiny object syndrome. The second cause is something that happened months ago. In a single day, approximately $21 billion of leveraged positions were wiped clean off the board. The largest single crypto liquidation event this industry has ever seen. The real damage wasn't the price crash. It was who got taken out. Market makers, the firms whose entire job is to keep trading smooth, to absorb your buy and sell orders, got caught holding positions nobody wanted. Many simply pulled back. When market makers thin out, a sell order that used to barely move the price can now send it crashing. That plumbing is still healing. Institutional rotation hitting thin liquidity hits harder than it should. That is the real story. Here's what I want you to hold on to when you see the next CNBC headline about crypto dying. CPI is running at 3.8%. The Fed's own preferred inflation gauge, PCE, just hit 3% and is rising for the second straight month away from target, not toward it. Real wages just turned negative for the first time since 2023. The personal savings rate just collapsed to 2.6%, the same level as the 2 years running into the 2008 recession. Every time inflation has been this high, the market has corrected by an average of 30% over the following 24 months. The stock market is celebrating record highs, while real wages fall, savings collapse, and inflation reaccelerates. That is not strength. That is the calm right before the smoke detector goes off. Do not let your conviction be swayed by a journalist who does not own any assets and is reading a teleprompter script about the current price. They are showing you the scoreboard. They are not showing you the game. Bitcoin is not falling in a vacuum. Bitcoin is doing what it has always done best. It is functioning as the world's smoke alarm. Gold is wobbling. Commodities are softening. Real wages are falling. The stock market is celebrating while the economic indicators underneath it are flashing warnings that have preceded every major correction in modern history. The stock market hasn't smelled the smoke yet. Bitcoin already has. Bitcoin is not the warning signal that comes after the crash. It is the one that comes before. Being early to the only asset that runs on math instead of mania almost always feels exactly like being wrong. The near term is noise at worst, and a gift at best. There is a $39 trillion debt hole that can only be serviced one way. U.S. money supply growth just hit its fastest rate in 4 years. The printer is already warming up. Every dollar printed is a dollar that makes every scarce asset more valuable relative to it. The moment the Strait of Hormuz reopens, oil gets crushed, yields fall, the dollar softens, and every asset that was waiting on that resolution reprices higher. Bitcoin at the front of the line the way it always has been. Bitcoin priced against the global money supply is the most undervalued it has ever been in its entire history. Not this cycle. Ever. While everyone else is piling into the AI boom, the one asset designed to absorb infinite money printing is on sale. Any one of these forces moves Bitcoin on its own. All three are loading at once. The people getting shaken out between here and the floor are reading the fast money scoreboard, priced in broken money. The people who understand what they're holding are reading the slow money, and they are not selling. If this helped you see the numbers more clearly, hit like and subscribe. In the next video, the one on-chain signal that has predicted every single major Bitcoin bottom in history, and exactly where it's reading right now. See you there.